What's up, everyone? It's Karthik with MoneyVest. So we've got a very important unemployment numbers coming out this Friday. So upcoming Friday, it's the first Friday of the month of August. So we are going to discuss exactly what to expect from the unemployment numbers, as well as how the markets may react to the numbers that are coming out, and of course going over some of the really important data points with regards to our unemployment spreadsheet over here, and how in the past different unemployed persons have led to different unemployment rates, and also the JOLTS number is going to be coming out, and the ADP non-farm payrolls as well. So this video is going to be solely focused on the overall labor market, the labor situation, and the unemployment numbers coming out later in the week. So hope you all enjoy this video, find it helpful. Make sure that you drop a like, I would really appreciate that, and subscribe to the channel if you haven't already. Again, links to our Discord and Patreon is going to be down below if you're interested in joining us, and also download the earnings volatility spreadsheet, which is absolutely free for you to download. You can also download the cash secured puts calculator spreadsheet, and also watch our 37 stock and ETF shopping list with my buy targets. And there is a 51% discount available until the end of this month. So again, 2 to 3 days left. If you want to take advantage of that, that's going to be available. This right here is a 21-minute video that you can watch, and again, get access to all my buy targets for over 37 stocks and ETFs. So link's going to be down below. So this right here is going to be the consensus, right? So non-farm payrolls month over month, consensus 180,000 jobs added in the month of June. So this is for the previous month, and 4.1% is going to be that expected unemployment rate. Private payrolls at 155,000, manufacturing payrolls to decline by 2,000, and participation rate at 62.6%, and average hourly earnings of 0.3%. Now, really, I want you guys to focus on the 4.1% number, which obviously is the key headline number, which many people are going to be reporting on. But importantly so, the more important number really is going to be the unemployed persons. So that's the civilian unemployed or civilian unemployment, right? So that's the how many people are actually unemployed in the US as a percentage of their participating population. So right now we're sitting at 6.81 million. So that's the number that we have plugged in over here. And you'll notice, let me just go over and explain this entire spreadsheet. So we got the US population at the very top, and you can see how the population has increased since the great inflation of 1970s from 226 million to 332 million. Of those people, people that are over the age of 16, in other words, that are eligible workers in the US are over 80%. That number has been pretty consistent throughout the years. So total eligible workers are 266 million, and participating population is about 166.5 million, right? So that is 266, 80% is going to be just the 260 eligible workers, and the participation rate of 62.594%. So obviously the reason for that discrepancy, that's 100 million there, are going to be people who are either retired or in school or disabled or just not able to work and participate in the entire workforce. So that participating population is 62.5% of the total eligible workers. Now, of those participating population, how many people are actually unemployed? 6.81 million. That's the 4.1% unemployment rate is what you get. Now, if this number continues to trend higher, which you'll notice that it is going from 5.5, 5.6, 5.7 million to somewhat higher levels, to 6.8, then as we are seeing, the unemployment rate will also shoot up, as it did back during the pandemic, back during the great financial crisis, back during the dot-com bubble. Every time we have gotten up to 8, 9, 10, 20 million unemployed persons, the unemployment rate has, of course, skyrocketed to 6, 10 to 14%. So just to keep things in perspective here, so if unemployment persons gets up to, let's say, 8 million by the end of this year, then we'd be sitting at just shy of 5% for the unemployment rate. And if this number gets up to, let's say, 10 million, then we'll be looking at almost 6% as the unemployment rate, which would be very similar to what we witnessed during the dot-com bubble of 2000. So, but of course, we've got time, and of course, we've got time to get there, right? It's not going to happen overnight. It's not going to happen in the next few weeks. It is going to take time. And one more chart that I want to show you is, of course, this one. And what this essentially represents is that every time we have seen interest rates as high as they are, this is something that we have discussed in our previous videos as well, unemployment has eventually followed. So what we have here is the federal funds rate in red and the unemployment rate in blue. And you can see that every time it has pushed up, has been during a time when interest rates prior to unemployment going higher were also at an elevated level. So if I essentially point that out, let me just take a quick screenshot of this and then bring it over. And if I point this out very clearly, you'll notice that, again, interest rates over here also. Let me just do that very quickly. So interest rates over here. So both times they are obviously higher. Unemployment was also increasing over here. You can see this right here again, interest rates extremely high, this was also during the great inflation of 1970s and 1980s. We did witness a significant increase in unemployment. Actually, interest rates are going to be over here in red. So this is interest rates, and unemployment, of course, eventually followed. This right here is, once again, interest rates higher for longer. Eventually, unemployment followed. This right here, interest rates higher for longer. Unemployment eventually followed. This right here is interest rates, and then you can see unemployment eventually followed. Interest rates were elevated, and of course, we did have the pandemic as well. And as a result, unemployment skyrocketed to highs of 12.5%. Now, this right here is where the focus is. You see that intersection over here between unemployment and interest rates. As interest rates continue to stay higher for longer, unemployment is already starting to show us some signs that it is moving higher. Some of the earlier signs that we witnessed in all of the previous times that it's actually moved up, because one thing happens first, the other happens after, right? It's not like unemployment goes up right alongside interest rates. Interest rates actually go up first and then unemployment follows. And the reason for that obviously is because interest rates take time to kind of play through to the entire economy. When interest rates are raised, it takes time to see the effects of that interest rate changes in the entire economy over months, weeks, months, and sometimes even years. And this, of course, has been one of the longest inversion of the yield curves. So this right here was some of the charts that were shared that were quite interesting. Of course, we know that this has been one of the longest inversion of the yield curves, lasting over 542 days. Right now, even more than 542 days, because this analysis is from all the way till April. And right now, of course, we are in July. So this is well over 600 days worth of inversion that we are witnessing. And every single time the U.S. has obviously gone through a bit of a recession, every time we've seen that inversion. So every time we see that uninversion take place, every time it starts to move back higher, is when we actually start to witness some recessionary signals and the U.S. economy weakening as well. So the longest inverted yield curve in the U.S. history continues to stress credit unions. And this right here is Goldman Sachs' recent report posted by Mike Siccardi. Goldman Sachs, why we're less worried about the rise in unemployment rate. The recent increase in U.S. unemployment rate has raised concerns about potential economic downturns, as historical patterns link such increases to recessions. However, there are three main reasons why the situation might be different. Layoff rates. Unlike past instances, the current rise in unemployment is not driven by increase in layoffs, which remain historically low. This means there isn't a vicious cycle of job loss leading to reduced spending and further job losses. Instead, the increase in unemployment is partly due to a surge in labor supply from immigration. Federal Reserve room to maneuver. If labor demand weakens excessively, the Federal Reserve has significant room, 525 basis points, to cut interest rates and would likely act and prevent a downturn. And temporary labor market frictions. Part of the increase in unemployment rate is due to the temporary factors such as higher unemployment rate due to recent immigrants and the need to reallocate workers post-pandemic. Now, one of the problems with this analysis is that it doesn't account for inflation. The second point they mentioned is that, yes, they've got a lot of room to cut, 525 basis points worth of room to cut, but are they going to actually do it? Because their main goal is not to help support the economy or unemployment. Yes, that's part of their dual mandate, but their main goal here, objective, is to really rein in on inflation and bring it down to levels consistent with the 2%. So if that doesn't happen, the second thing won't happen. In other words, the Federal Reserve will sooner or later will have to make a very difficult call whether they cut interest rates to help support the economy and unemployment, or whether they continue to keep interest rates higher for longer in order to bring inflation back down. So that is going to be the real question for the Federal Reserve. And let me know in the comment section down below, what do you think? What is the Federal Reserve going to eventually pick, if it ever comes down to picking between inflation and unemployment? I do strongly believe that there could be some political pressure for Jerome Powell and monetary policy in the Federal Reserve to cut interest rates, because everybody's going to want a short-term temporary fix to control the economy, to bring unemployment back down, to create more jobs. So there could be more political pressure to cut interest rates, but knowing Jerome Powell and what he's learned from his historical, previous chairmen of the Federal Reserve, from Paul Volcker and the like, keeping interest rates higher and increasing them further is the right call, because there may be pain in the short term, but that's more important for long-term success of bringing inflation back down. But I hope it doesn't come down to that. The Federal Reserve is really praying and hoping that by the time unemployment actually starts moving higher, by the time this number actually starts get going, inflation is already back down to 2%, if not lower, so that they don't have to worry about making that tough call, that hard choice to pick between inflation or unemployment. So that, I think, is going to be really, really interesting over the next 6 months for us to witness and monitor. But one thing is for certain, where I do believe that if interest rates stay higher for longer as they are right now, unemployment is at risk to moving up. It is at risk to pushing higher, whether it is shortage of labor, supply, or whether it is due to immigrants, whether it is actual job loss or layoffs. For whatever reasons, I do believe unemployment is on its way higher if inflation doesn't come down and if interest rates stay higher for longer. So that is going to be available for us. That's the data that we're really watching moving forward. So again, this is going to be those expectations. I wouldn't be surprised if we do see, again, unemployed persons starting to increase a little bit further, causing some more short-term weakness in the market. But at the end of the day, as I've already mentioned, all of that leads to very good buying opportunities, very good, very serious dollar cost averaging opportunities for the market, for us, right? For us to DCA into the market, because eventually we do understand that this is going to be a short-term to mid-term problem, and eventually this is going to sort itself out where there is going to be higher levels of productivity. And again, my bet for the long term is still going to be on technology, cybersecurity, semiconductors, autonomous vehicles, artificial intelligence, robotics, so on and so forth. So let me know in the comment section down below, what do you think with regards to unemployment numbers and also the Federal Reserve's choice to make between inflation and unemployment. As always, if you enjoyed this video, find it helpful, make sure that you drop a like and subscribe to the channel. And as always, happy investing. I'll see you all in the next video.